You're watching Masters in Trading Live with Jonathan Rose.
Hey everybody, it's Jonathan Rose and welcome to Masters in Trading Live. So my name is Jonathan Rose. As I just said, we get on here live each day the market's open, 11 a.m. Eastern Time. So I've been doing nothing but trading my entire career. My voice just went. We're live. So I've done nothing but trading my entire career. I'm out here in Chicago. I've worked at all the biggest exchanges out in Chicago, the Chicago Board of Trade, Chicago Options Exchange, the Chicago Mercantile Exchange. And now I get on each day to try to add value to all of you guys watching. This is free. After we do the free portion, I break off to our all access, our paid portion, where we go over our active positions, but we still share trades on here quite frequently. I got the chat open. We always hop on every morning and say good morning. Today, we're going to cover the line in the sand. We are at an inflection point for the market right now, specifically tech stocks. I want to go over our line in the sand. Our line in the sand yesterday proved to be pretty reliable resistance. Market sold off, but didn't really sell off that much. So we're going to look at the market, and then we're able to take off a wing-dinger of a trade. I'm going to go over that. I want to explain exactly how we found the trade and why we took off that trade. Hopefully it helps. I'm going to move over to the screen share. I got the chat open. Eric, Greg, Adam, Harry, Navi, Richard, Brad, all of you guys. I love that you guys hop on here early. Give the video a thumbs up, and let's go to the screen. Let's have some fun. Okie dokie, here we go. Roger, John, how you guys doing? Okay, guys, this is where we were yesterday. Here's our line in the sand, right? 522. I'm going to pull up a live market as well. 522, guys, in the QQQ. The QQQ is the NASDAQ. The QQQ is tech stocks. When we do technical analysis, ideally, we want to narrow the market down to one key level. And that's what we've done here, 522. So I'm going to pull up a live chart. Last trade, 518.80. Look at this 522 level. If I put it on 10 days, and we shared this level, we've been sharing this level for a little bit, but here's how it looks. Really, it's just a significant level. I like to call it kind of common sense trading, guys. But look, if we even look at this for more days, let's say we go 30 days. It's pretty obvious, right? You guys see that? 522. 522 has been the high of the last couple of weeks. And you can see the market trades up there and it fails. It trades up there and it fails. It trades up there and it fails. Now, it's not failing by coming down to 490 or 500, right? It's just kind of bumping up against resistance. It's a really, really, really powerful number. 522, line in the sand. And now, if I was going to speculate a little bit, guys, on where I think this is going to go, Ernie, great question. I'll get into your question. Because the market's not selling off on this line in the sand, I actually think that it's really strong. So we're under the line in the sand. The market's a little bit weak on this Friday, but because we can't really sell off, that's why I'm turning bullish. So again, I'm going to pull up that chart. And I want you to understand the why. I want you to understand why at this level, I'm turning bullish. At first time we were going to get up there, I thought we would have a difficult time getting through, just like we had a difficult time getting through, but we're not selling off. We're not selling off. We're staying strong. The longer that we hang by this level, the stronger the market is. So as much as we're under the line in the sand, volatility is not spiking. And I don't think that we are going to sell off. I actually think that we're going to rally from here. And I would think that we take out the line in the sand and that becomes support. And again, that's just me speculating a little bit. The VVIX 96.75. The VVIX, I'm sorry, that is the VIX of the VIX. When things were going crazy in April, the VVIX, the VIX of the VIX shot up to 180. Again, that VVIX is the VIX of the VIX. How much fear is in that fear index? That's when it's shot up to 180. Lots and lots of fear. The fear is out of the market. When the fear is out of the market likes to go higher. Okay? The market is all about fear and greed. Ernie question. So in very broad terms, when a position goes way against you, when do you add a tranche versus when do you admit defeat and move on? It's a good question. Ernie, I'm going to hold off on your question because I have some slides that will better answer your question once we talk about refiners, which I think we're going to do right now. No, we're going to talk about portfolio management. So, Ernie, I'm going to get to your question. Question from Dr. Jonathan. Would you say that, especially since this is Friday, so I'm going to agree, this is Friday, when lots of times institutions dump if it's weak, the fact that they aren't dumping is super bullish. I don't agree that institutions dump if it's weak. I think that's a very, very general, broad term that really doesn't mean very much. So in the most respectful way, and I'm calling you by Dr.ai, Dr.al sounds weird to me, but if I go back to the chart, I don't look at it as institutions, I don't know what that means. I want to take it simple. I want to take a step back. When we get to this point, resistance, the market should sell off. The market should fail, but it's not failing. And the reason it's not failing is because it's holding up there. So, yeah. No, I know you're emphasizing the Friday aspect, but I don't think that's true. I think you're making that up. I think that it's a buzzword that institutions dump on a Friday. I don't think that's true. So, and I say it respectfully. I don't mean any disrespect by this. I'm just saying this is how I look at the market. Okay? So, as the market is strong here, the market should fail. This should happen. After this didn't happen, the market, the more times it bumps up, it's going through. So it's just strong. No, and it's a really good question. It's always difficult to talk when one person is writing while I'm talking. But if we just take a step back, there's not a lot of volatility here. The market should fail. It wants to fail, but it's not able to fail. So if we can't go lower, we're going higher. Right? So that's how I'm looking at the market right here. I think it's holding up really nicely. I like the question. Okay, I want to talk about portfolio management because I think this is probably the lowest hanging fruit for all of us to get better. I have a position in front of us. Portfolio management position. Let's say this is a mock portfolio. Microsoft, Apple, NVIDIA, QBTS, IonQ. Those are two quantum stocks. So we have three big stocks, trillion-dollar companies that are in the QQQ, and then we have two quantum stocks. I want to have this portfolio management conversation because I see it too often when traders will have a position like this. And when the market's going well, cool, you're making money, that's fine. But what you're doing is you're isolating your risk. I think this position, actually, what I wanted to say was instead of having 5 positions, I want you to look at it as having 1 position. So don't look, if you have 5 positions, you don't have 5 individual positions, you have 1 position. This position right here, I think it is the exact same thing as this position. Again, this position for the average retail novice trader is the exact same position as this. Why? The reason is because QBTS and IonQ are the same position. Okay? You're not going to make more by having 2 of them than you would if you had 1. Because what's going to end up happening is you're going to cover too quickly as soon as they start working because you have too much risk on. So rather than have 2 quantums and 3 NASDAQ stocks, I want you to pick. You're going to have less risk doing this with the same amount of upside as doing this because of correlations. If you do want to have a position like this, I would recommend this. This way you can hold all 5 of your positions, but if shit hits the fan, if something goes wrong, this red being long VIX, right? The VIX is the fear index, so you can hedge your portfolio with long VIX. You could also hedge your portfolio by having some QQQ puts, some NASDAQ puts. But rather than this position and this position, I'd rather see you have that position or just Nvidia and one of the QQQs. Trade less, hold things longer. You're going to have less portfolio risk. And in my mind, and from experience dealing with lots and lots of traders, you're not going to sacrifice your upside at all by having less and holding things a little bit longer. Does that make sense? Sometimes I like to call this garbage collecting, where you're buying everything. Everything looks good. Don't buy more than 1 quantum company, guys. You don't need more than 1 chip company. You don't need more than 1 play on China. You don't need more than 1 refinery play. Find different trades that you like, and those are the trades that you want to build into your portfolio. I just got a weird comment. Hedging. No thanks. To make money in the markets, you have to be comfortable with risk. Okay. You're still taking risk. We're just trading. Dennis, what is an appropriate hedge? So a really good feel for what an appropriate hedge is when the market's going down. Are you getting killed? Do you have too much risk on? If you feel like you're getting killed and you have too much risk on, well, add a hedge. Feel. If you don't have enough, you'll end up putting more. But overall, look at what the market's doing. If the market is selling off and your P&L is getting killed, there you'll be able to see how much insurance that you need to buy to protect your position. Okay? It's not a set number. It's more of like, what kind of hedge do you need to protect your position? Let's move on. Picture, beautiful picture of oil refiners. I really like trading oil refiners. I like trading oil refiners using the crack spread. The crack spread is the profit margin for oil refiners. This morning, Chris is my managing editor. Chris put it in our Discord community. Guys, Dyno calls. We are going to get out of Dyno calls. We are going to cover our position in Dyno calls. I want to explain to you exactly why we did this trade and why we're covering this trade. Because you want to get into a trade for a reason. You also want to get out of a trade for a reason. So we shared this in Dyno at 9:14 this morning, 1 hour ago. Ernie was able to lock in 400% on his Dyno trade. Eck was able to make 65%. Wade was able to make 90% overall. I just took these guys responded right after, so I took the first 3 testimonials that came in. Let me explain the trade though. This yellow line is the crack spread. The crack spread, there's a basic formula to use for the crack spread. This yellow line is the crack spread, and all these other lines, those are the oil refiners. This trade is really, really simple. It's almost too simple, where it sounds like overly simplistic. Wherever the crack spread goes, the refiners follow. The crack spread, this yellow line, is literally the profit margin for all these companies. Imagine you could follow the profit margin for Apple. How easy would it be to trade Apple stock? Well, here's the trade. The first trade that we did, one, was May 19th. Why did we do this brown line? Look at the yellow line. Our second trade. Why did we do that trade? Look at the yellow line. The third trade. Why did we do that trade? Look at the yellow line. Why did we get out of Dyno? You guessed it. Look at the yellow line. Keep things simple. Trading doesn't have to be so hard. The most difficult thing about trading is learning a lesson like this. Learning a lesson that if refiners going lower while the profit margins are going higher, that is a very, very easy, straightforward trade. So these are all the trades that we did. We locked in 50%, 22%, and 22% on those 3 trades. Ernie, you did way better. Congrats. Really nice trade. We like to celebrate with glockenspiels when we make great trades. 1 sec, let me get back in there. I got a question. Where would you set stops as a percentage on long stocks? I don't set stops, Eric. I just don't. I don't set stops. Why don't I set stops? Here's why I don't set stops. I have 1 portfolio. I don't have 5 positions. I have a portfolio. So in order to set a stop, and this is a longer lesson, I prefer having a stop based upon your P&L. So if you have $100,000 that's set aside for the trading portion of your account, for the at-risk portion of your account, when I work with traders, I want to see that 100 go to 105. I want to see it go to 108. I want to see it go to 113, 118. If I was going to have a stop, if I was to have a $100,000 account, I might look at that stop as like 95,000, 92,000. That's when I would de-risk. That's when I'd clean myself off and get back on. So rather than looking at a stop as individual, the entire stop needs to be a portfolio. If I go back and look at that example of the crack spread, we got out of the crack spread when the crack spread rolled over. If the crack spread continued to go higher, we don't get out of the refiners. So therefore, I can't have a stop because Dyno could trade lower while the crack spread trades higher. If I stop myself out, I'd rather be a buyer than a seller. So it takes experience. It takes time to be able to have the confidence to trade without stops. The easiest way for traders to learn to trade without stops is when you trade options. These Dyno trades, when we got into this Dyno trade and it was May 19th, our original trade was $2.24. When you get into that trade, you need to look, and I would ask Eric, if you got into this trade, you're risking $224 per contract. If you want to risk $1,000, you could do 4 of them, but we're not risking $1,000 with a game plan to only lose 500. It doesn't work. If you're risking $1,000, the most you're committing to that trade is $1,000. Okay? It's a little bit different of a mindset. It's something that I've worked on over 27 years in the business. So really great question. Appreciate you asking. This was fun, guys. A little bit longer than we usually do. We have our all access portion. In our all access portion, we are going to talk about a lockup trade that is finally coming off. That's what we're going to talk about in our all access. For everybody else, guys, thanks so much. Have a great weekend. Don't remember to give the video a thumbs up. It really helps. And I'll see you guys live Monday, 11 a.m. Eastern time. Chris, thanks for sharing the number. You guys want to learn more? We got some really cool promotions. Give a call, 1-800-304-5601. Tell them Johnny sent you. I'm just kidding. I mean, you could. All right. I'll talk to you. Bye.